Well, silver is lagging gold. Gold is pulling away, which kind of tells me that we might still want to be a little bit cautious here in dollar terms, though the bull market in gold especially is pulling away from other commodities. The gold to commodities ratio is rising fast now. And it looks like the gold to stocks ratio is finally starting to break through its downtrend line since 2011, but hasn't quite broken through its downtrend line since 2012. I'll show you those charts. Update on reverse repos. There are about 350 billion of those left. Those have to be emptied out before we run out of extra dollars in the monetary tank. And I'll give you an estimation on when I think that will happen. According to Bank of America estimates, sometime in the next 2 months, we'll see.
In today's episode, Rafi Farber talks about the recent surge in gold prices relative to other commodities and signaling increased investor caution amid market uncertainty. The gold to commodities ratio is rising rapidly, indicating a strong bull market for gold. Silver, while showing some gains, lags behind, suggesting a more cautious approach is warranted. Investors are advised to stay alert as the dollar value of gold may experience short-term volatility. In the banking sector, the reverse repo balance stands at $350 billion and is expected to deplete within the next 2 months, according to Bank of America. Declining bank reserves add to financial stress, with the yield curve remaining inverted, an important recession indicator. Typically, a recession follows once the yield curve breaks above zero, which has not yet occurred. Global economic movements add to the uncertainty. The Bank of Japan's recent rate hike resulted in a significant drop in 10-year Japanese government bond yields, reflecting investor expectations of an impending recession and future rate cuts. This unexpected strengthening of the yen indicates a complex and interconnected global financial landscape. Smash the subscribe button, hit the like button, and turn on notifications so you do not miss out our daily recaps. Also, check our links in the description for full vid credits. Enjoy the episode.
As quickly, I'll try. Gold continues to pull away from other commodities. While people are focused on the dollar amount and the new all-time high past 2,500, yes, this is true, but it's not really what I think is so significant. I think this is much more significant. The fact that gold to CRB ratio, CRB is the Reuters Jefferies CRB commodity index, is now past 9. And you can see here that this matches the resistance zone hit in somewhere around September in 2019. Before we hit an all-time high of past 15, I think that's 15.7 something, at the peak of the lockdowns of 2020. I think this was April 20th, 4/20, as I remember the date, when oil went to negative 35. The point here is that gold is continually outperforming other commodities, which means that the monetary nature of the commodity itself is starting to show again. And it's not so simple in terms of dollars because, as you might recall, in this record-breaking rally in gold versus other commodities, we had that huge sell-off in dollar terms from about 1800 something to 1450. It was very scary for gold and even scarier for silver, but nonetheless, it was still rising precipitously versus other commodities, some of which were going into negative territory at the time. So while this gold in terms of commodity rally extends and continues stronger and stronger, in terms of dollars, we might get a little bumpy here as we encounter what looks to be another dollar crunch. You can see that happening in tech stocks and other little bubble stocks that we see being mentioned on mainstream news sites all the time. But let's continue. So this is silver. Silver is also outperforming commodities, especially since 2022, September 2022, but it's still lagging gold here. It's not really pulling away. It's kind of coiling around the 200-week moving average here. So given that silver is lagging gold right here, I'd say that the gold rally might be in commodity terms, but in dollar terms, it's going to get a little bumpy in the short term in the next few weeks. So I'd be careful here, especially for trading. And you can see here on that record gold rally in terms of commodities, silver was zigzagging like crazy. It was very hard to hold on if you were trading ETFs or something like that. If it was physical, obviously it's much easier, but that's a different strategy. Gold to stocks ratio breaks 2011 downtrend line. Look at this. So here is the high in gold to the S&P 500 back in August 2011. And we hit that trend line here in March, April 2020. It looks like we've broken through that downtrend line, and now we are skating above it. It looks like here we have a head and shoulders bottom here and a major bottom in 2022. So as the gold to stocks ratio rises again, people are going to be logging into their brokerage accounts, realizing that their stocks are not maintaining the value that they thought they were. And then people are going to start getting more nervous and moving into gold and silver. Still, though, the trend line from 2012 has not been broken yet. It looks like we're still pinned below it if you want to count from here. Again, these trend line, these aren't exact science. This is not an exact science. It's more of an art. So it depends where you want to count it from. If you count it from here, which is the beginning of the gold bear market in terms of stocks, when it really started to decline seriously, it looks like we're still pinned below it, and we'll see if we can break through it in this rally over here. Looks like the trend line is somewhere around 0.45, 0.47, something like that. And we're right now at 0.46. Now, people have been asking about reverse repos because I thought they were a big deal several months ago. I still think they are, but nothing has happened with them lately in 2024. So I just stopped talking about them because there's nothing to talk about.
In today's news recap, Chinese silver trading powerhouse eyes expansion in Singapore. The commercial division of Chinese private smelter Henan Jinli Gold and Lead Group Co. is looking to expand its commodities trading team in Singapore as the industry turns increasingly bullish on copper, aluminum, and other metals. The division, which handled about half of China's silver exports last year, is aiming to hire more physical and derivative traders for industrial and precious metals, said Eric Hu, general manager of the trading arm, in an interview in Singapore on Friday. The company hopes to grow its trading team in Singapore from the current 4 to 15 to 20, said Hu, a 2-decade silver market veteran who currently leads a group of more than 100 metals traders and other staff across Shanghai, Hong Kong, and Singapore. I know it is not easy and will take a long time as competition for talent is getting intensive, he said. Metals markets are being transformed by increasing demand from renewable energy installations, artificial intelligence, and supply shortfalls. That's encouraging some of the world's biggest energy traders to get more involved in metals, a sector that's been dominated by behemoths Glencore PLC and Trafigura Group. Jinli Industrial International PTR, the Chinese company's Singapore subsidiary that officially started operations last October, has hired Noel Ruan from Mercuria Energy Group and Bruce Wang from Citigroup Inc. in the past 6 months, Hu said. Both confirmed their own moves. The company's Hong Kong trading subsidiary sold about 2,000 tons of silver ingots from different smelters in China to overseas clients in 2023, including top bullion banks such as JP Morgan Chase & Co., Hu said. Official customs data shows. Now smash the subscribe button and turn on notifications so you do not miss out our daily recap. Enjoy the episode.
We have less than 350 billion left in reverse repos. That's the same number that we had throughout much of 2024. It's not a record low. The record low was post-tax day 2024. But you can see here that the reverse repos, the extra dollars in the tank, have not emptied since then. And why is that? Because there hasn't been any net issuance of treasury bills. When banks want to take money out of the reverse repo facility, they need someone similar to put it in terms of duration and yield. And the only real option for them is treasury bills. And so we see here two things. On the right first, this is from SIFMA. I forgot what it stands for, but they track issuance of treasuries by tenor. And here you have the net issuance of treasury bills in 2024. So if you add all these numbers together, some of them are negative because there was negative issuance for April and June, meaning more redeemed than issued. So that's 90 billion. If you take all this together, 90 billion in net treasury issuance since all of 2024 from January to June. So that's not enough money to drain out of the reverse repos if only 90 billion have been issued on net. And so we see here on the left, this is Bank of America's estimate for the total net bill supply for 2024. And here they write $794 billion. So far, it's only been 90. So if you take 794, you subtract 90 for what's already been issued on net, you have 704 billion by the end of 2024. At that rate, if it's an even rate, then in the next 2 months, we should see that $350 billion drained and reverse repos finally zero out. I don't know if Bank of America is correct. This is just according to their numbers. We'll see what happens. And I wanted to talk about for a second the 10-year minus 2-year yield curve. We've been seeing a lot of articles lately that the yield curve is broken, and it's not predicting recessions anymore. It doesn't work. But that's not true, because if you look at this chart over here from Fred, we can see the yield curve inversion every time it goes below zero. That means that 2-year yields are above 10-year yields. And what happens here since 1990, or before 1988, 1989, every time the yield curve inverts, there is not a recession until it uninverts. You see here the shaded areas are recessions, and when the yield curve uninverts, then you have the recession. Same thing here in 2000. There was an inversion in 2000. The recession did not start until 2001, where I'm talking about a Keynesian recession. This is just when malinvestments are revealed. The problems of the boom economy are revealed. People didn't reveal their boom problems, you could say, until 2001. And same thing here in 2006, 2007, yield curve inversion here. And then there was a major uninversion as we went back above zero, and only then was there a recession. And same thing here, we had a very minor inversion here. You can't see it on the zoomed out chart, but if you zoom in, it is an inversion. And once we had going back to above zero and uninversion, then you had the recession over here. One could argue this one is a little bit artificial because of the lockdowns, but I'm not going to get into that right now. So the point is here, we've had an inversion of the yield curve since 2022, I think this is, and it continues to this day. Now we're still below zero, but we're headed towards the zero mark, and we're going to break through it. We see that because we're seeing moves in interest rates now. 10-year yields are really starting to fall. I think that is the prelude to a Keynesian-style recession, which will lead to the final money printing round, which we're all waiting for. So the yield curve indicator is not broken because we have not broken back above zero yet, which is when typically the recessions actually happen. We're going to go to the next issue right now, and that is the repo rate. The repo rate as of yesterday, so we have the repo rate is now 5.38. And the peak should be today, August 2nd, where we get data for August 1st, which is when the rate typically peaks. Now, if we have a rate above this, above the July 1st and January 2nd, which was the first business day of 2024, above 5.4, then we're going to see, then that means there's some real stress in the repo market. And why is that stress coming? Because reserves are falling hard. Again, reserves, bank reserves, the ghost of dead debt, as I now call them, are down $100 billion since last week. We're at 3.178 trillion. I believe the crisis line is somewhere around 3 trillion. We've been around here before. We could jump around, but I'm hoping that the reserves keep falling from here. And what does that mean? So the bank reserves are what's used to lend repos from bank to bank. The banks with excess reserves loan to the banks without any excess reserves, and the small banks get squeezed and squeezed for all that interest. Isn't that great? So the ratio of repos to reserves right now is back up to 69%. The crisis area over here is somewhere around 83, 84, 85. So we're getting closer as repo volumes grow and grow and grow, and reserves shrink and shrink and shrink. Only one direction this can go in, and it's going to be a collision, and it's coming. It's coming soon. Exactly when, but we see the stress in the stock market. We're seeing stress all over the place. Why the yen is rising? We heard that the Bank of Japan raised yields, hiked rates by 25 basis points. So according to my thesis, the higher that Japanese government bond yields go, the weaker the yen becomes, because the yen is the other side of Japanese government bonds, because the Japanese bank, the Bank of Japan, owns so many bonds. So it's the same thing. So as bonds weaken, so should the currency. So why, if that's true, why, if bonds just weakened, why is the yen rising? Shouldn't be. But you see here that it's only they only hiked rates on the short end, right? The 10-year yield was way down when that hiking happened. Why? Why is that? Well, because I guess Japanese investors do not believe that the Japanese economy can handle hikes for very long. So they're fronting up, they're buying 10-year Japanese government bonds, forcing the yield lower in anticipation for major cuts that are going to happen after these small, tiny little hikes are going to cause a major crash, which is already happening in Japanese stocks. So as you see here, as the yield goes down, the yen to dollar rate goes down, which means the yen is strengthening. This correlation has not broken. It's still accurate, and
What do you think of the current macroeconomic situation? Do you think Rafi Farber is spot on? Will gold and silver raise in the upcoming recession, or will metals get sold off like the rest of the market? Post in the comment section down below your honest opinion on Rafi's take and share with the community if you're worried about the looming recession in the United States. Thanks for watching till the end. Now check this video right here because you'll love it. I see you on the other side.